All right, let's dive right into this explainer with a pretty big question. Can the absolute chaos of the financial market actually be decoded into a predictable map of human psychology? I mean, every single day, millions of trades are executed across global exchanges. It looks like total random noise. But if you know exactly how to look at it, a very deliberate structure actually begins to emerge from all that chaos. So, can a simple little shape actually predict where the market is heading next? Well, the short answer is that these shapes, or chart patterns, act as a sort of hidden language. Now, they don't give us a magic crystal ball, but they absolutely do reveal vital high probability clues. They tell us if a current trend is going to continue racing ahead, or if it's about to violently reverse course and trap traders who just aren't paying attention. Think of chart patterns as the literal footprints of buyers and sellers. Whether you're looking at stocks, Forex, commodities, crypto, you name it, human behavior, specifically fear and greed, remains remarkably consistent, and it leaves distinct marks. Huge institutions and algorithmic traders leave these massive footprints behind as they build or dump their positions. Learning to read those marks, that gives you a huge edge in identifying exactly when momentum is shifting and where the smartest money is flowing. To make this super easy to digest, we're going to break down the 10 most essential patterns into 4 quick themes. First, spotting the reversals. Second, the tail of triangles. Third, flags and cups. And finally, the most important one of all, the golden rule, risk. Okay, part 1, spotting the reversals, or the market U-turns. This is the zone where old trends die and new ones are born. Notice how these two patterns perfectly mirror each other. You've got the double top, which forms a giant M. Price hits resistance twice and completely fails, which visually signals that buyers are just exhausted. That second failed attempt is the key, right? It proves there simply isn't enough buying pressure to push the asset any higher. Then conversely, you have the double bottom, forming a W. Price tests support twice and holds firm, signaling that sellers are totally tapped out and buyers are taking the wheel. That double test validates the strength of the floor. Now, why does knowing this specific structural shape actually matter? Because it completely removes the guesswork. It tells you exactly how to manage your risk if the market suddenly changes its mind. If you're trading a double top, you drop your safety net just above that second peak. For a double bottom, it goes just below the second dip. Placing your stop loss right there turns what could be a wild gamble into a highly calculated business decision. Now let's talk about the granddaddy of them all, the head and shoulders pattern. It basically forms in 4 distinct steps. First, an initial peak forms the left shoulder. Then, a massive push from buyers creates the highest peak, which is the head. But then, momentum just fades. The next rally is way weaker, forming a lower right shoulder. This failure to make a new high, that is the ultimate loss of momentum. The absolute key to watch here is the neckline, the floor connecting the lows of those peaks. Once the price breaks down through that neckline, the pattern is confirmed. The uptrend is officially dead. But hey, flip that exact same psychology upside down and you get the inverse head and shoulders. It forms at the absolute bottom of a downtrend and represents a massive accumulation phase. You get a low, then a deeper low to shake out those final panic sellers, and then a shallower low as the smart money starts stepping in. Breaking the neckline on the way up transforms this from a signal to sell into an amazing buying opportunity. It's the exact same mechanics, just inverted. Moving on to part 2, the tale of triangles, the ultimate battlegrounds. While reversals are U-turns, triangles are periods of consolidation. Think of these 3 formations as your ultimate cheat sheet. An ascending triangle has a flat roof of resistance, but rising support. This means buyers are getting more and more aggressive, squeezing the price up against a ceiling until it breaks. Very bullish. A descending triangle is the exact opposite. A flat floor of support, but falling resistance as sellers aggressively push the price down into a corner. That's a bearish signal. But then, things get interesting with the symmetrical triangle. The symmetrical triangle is a truly neutral battleground. Both lines converge equally, meaning neither the buyers nor the sellers have total control. The suspense just builds as the price gets squeezed tighter and tighter. Because it can break in either direction, the golden rule here is ultimate patience. You literally have to wait for the actual breakout to confirm the direction. And pro traders, they will always watch for a massive spike in trading volume to confirm that the breakout isn't just a fake out, but a genuine new trend. Next up, part 3, flags and cups, also known as the highway. These are the fast-paced continuation patterns. Think of a flag like a quick pit stop on a long road trip. A bull flag starts with a massive, sharp upward movement. That is your flag pull. Then the price consolidates slightly downward, creating the flag shape. Now, this isn't a reversal. It's simply institutional traders locking in their profits after a big run, which causes a slight dip before the broader market piles back in. Once price breaks above that flag, the bullish trend resumes with some serious force. The bear flag is the exact same logic, but in a downtrend. Sharp drop, quick upward breath, and then a brutal breakdown. Another incredibly reliable pattern here is the cup and handle. First, you get a gradual decline that eventually rounds out at the bottom. This rounding shakes out the weak hands and builds a steady base. Then, as the price recovers back to the previous high, it pauses. This creates a small downward drift, which is the handle. The tension is basically brewing right here. Once the price breaks above the resistance of that handle, the pattern is confirmed, triggering a massive potential continuation of the uptrend. And finally, part 4, the golden rule, which is all about risk. Because knowing the map is great, but navigating without a shield is just reckless. I want to slow down for a second and highlight this direct quote from our source material. No pattern guarantees success. Listen, chart patterns are a game of probabilities. They are not a crystal ball. Even the most perfect-looking head and shoulders or beautiful bull flag can suddenly fail if a random macroeconomic news event shocks the system. You have to accept that losing trades are just part of the process.
Because patterns can and absolutely will fail sometimes. Your long-term survival depends entirely on these rules. Master your risk management. Never enter a trade based on a pattern without immediately placing a stop loss. Combine these visual cues with proper market research to understand the broader context. And above all, practice consistently. Over time, identifying these formations in real time goes from feeling like guesswork to being absolute second nature.
So, we've covered the U-turns, the tightening battleground triangles, the high-speed flags, and the absolute necessity of risk management. The footprints of human psychology are stamped all over every single chart you will ever look at. The only question now is, now that you actually know how to read the hidden language of fear and greed, what is your next trade going to say about you?